I'm Daniel Schwarzman, Director of the Seeking Alpha Marketplace, continuing our roundtable series with marketplace authors. Today I'm speaking with Victor Dergunov, the author of Albright Investment Group, a service that provides top performing growth strategies and deep value insight. So, Victor, how are you doing?
I'm doing excellent. Thank you, Daniel.
So, we're talking about two different sectors. We had recently done a tech roundtable. I wanted to start there, but then you also mentioned you have some interest in mining. So, let's start with tech. And it's already June 4th. We're sort of the last gasp of tech earnings. Zoom reported this week. Slack is due to report after the bell, so some of the upstarts. But you sounded concerned about Q2. And I wanted to ask, it seems like an obvious thing to be like, we know that Q2 is going to be a really bad quarter because the lockdowns primarily happened in from, let's say, March to mid-May. How much do you think what do you think the market is expecting versus, you were sort of expecting a little bit of a downturn. How are you balancing out what everybody knows versus what they don't know?
First, I want to say that we've been bullish on mining for a long time, on gold miners, silver miners. As soon as we realized that the Fed was going to start easing back in 2000, after the 2018 correction, we realized that mining was the place to be, and a large portion of our portfolio has been devoted to gold mining stocks and things of that nature. As far as tech goes, we've been bullish on tech for many years actually, and tech has done extremely well for us. And yeah, so there was a bottom recently. Obviously, everybody knows about it, the mid March bottom. We called it at our Albright Investment Group. We called it within a few days. So we got into a lot of the tech stocks and a lot of stocks in general. We put out a 50 stock buy watch list at that time, right when the market was at around 22, 2300. So we were right there, and we picked up a lot of the names. Some of our favorite names were Tesla. I'm a long Tesla bull. A lot of the readers know this, obviously. So we picked up Microsoft and many of the big names, Facebook, Google, et cetera, et cetera. But as we saw the rally progress, and it was like it went up a month, and then it went up 6 weeks, and it just kept going up. We realized that maybe it was time to take some profits because it just felt like the market was only looking at the positive, to be frank. So right now, my view on the market, and I guess the tech sector combined with the market, if we look at it that way, um, I would say that the market is very, very optimistic. Things are gonna jump back to normal relatively quickly. So everybody knows Q2 earnings are gonna be very, very poor, right? Or relatively poor. Let's call it. But the question is, how bad are they gonna be? But there's also a bigger question. The bigger question is what's going to happen in the second half. What's going to happen in Q3, in Q4, and then in 2021 as well, because no one really knows. Are we going to have another wave? I'm in the camp that thinks that we are going to have another wave. Is it going to be as detrimental as the first wave? Maybe not, possibly not. Nevertheless, it could impact business activity and obviously stock prices. Right now, if we look at some tech valuations, I would say that they're about fair right now because there are so many different factors going on. We have the Fed, we have the QE unlimited, I call it, QE infinity, some people call it, but basically it's just an unlimited amount of capital liquidity being poured into the system. So that is very beneficial to the market. But on the other hand, we have a lot of uncertainty because we don't know um, what kind of slowdown we're looking at, in H2 and in 2021. is ad spending gonna slow substantially for companies like Google and Facebook? That's a big question. Are hardware sales going to slow down for Apple, chip makers, et cetera, et cetera? So these are kind of the things that I'm looking at right now.
So let me just, you kind of gave the market outlook there, which was cohesive and clear. But my question to you is, we get to Q2 earnings season, we're in Q3. I guess what you're suggesting is that the real focus is what is guidance looking like? What, as that uncertainty turns into certainty, what is that picture looking like
Look,
right now?
Daniel, I'm sorry. Look, the bottom line is that I believe we're gonna have another correction this summer. I believe this. So the market ran up 40 some odd points in about what, like under 6 weeks. That is a lot. That is a whole lot given the uncertainty that we have. I expect that. I'm, I mean, it's it's a basic thing to understand that the market can't go up forever. Just like trees cannot go to the sky, the market cannot keep on going up without a correction. Now, a logical time, the market's not always logical, but I'm trying to look ahead here. So, I will go out on the limb and I will say that this summer there will be a correction. It could be starting today. It could come 2 weeks from now. It could come in July. But sometime this summer, in my view, we're gonna have a correction into Q2 earnings. See, and then once Q2 earnings start coming in, and investors see that they're bad, but stocks are down, stocks have corrected, earnings are poor. We knew they were going to be relatively poor. They could be worse than expected. But there's this kind of optimism in the air that I'm sure we'll catch on again, and we're gonna have another wave higher after that.
So you're saying actually it's not Q2 earnings that's going to be the issue. It's you just think the market will naturally correct going into that, and that'll reset the table for.
Absolutely, absolutely.
Okay.
The market is a living, breathing animal, and that's just how it moves.
Well, it's just so interesting because this whole 5 month period or 4 month period has been a game of what do you think that I think that you think that I think in the market where we didn't care about coronavirus. Then it became clear that it was going to affect the Western world more strongly. We started caring really fast. Then the Fed stepped in, and all of a sudden the worst seemed out the door. But you know what I mean? Like where we know Q2 will be bad, but it's this sort of game of what's priced and what's not, and so it's really a
Right,
challenge.
right, right. And it's really all about looking ahead at the market because in early February I was still bullish. I wrote an article about stocks going up because I really thought that this coronavirus debacle thing, catastrophe, whatever you want to call it, I thought it was going to be contained. But when I realized that it was not going to be contained, in late February, I changed my position. And right around the top, I put out an article, to my group members. I also put out another article on a public article as well, saying that there's going to be a correction. Now, I did not realize that it was going to be a 30% correction or bull market or 35% bear market. I'm sorry. Um, but I was betting on a correction up to 20% in the beginning of February, or I'm sorry, in the end of towards the end of February. Now, as the market progressed going down, and I realized the veracity and the violence and the volatility of it all, I realized that we are actually entering a bear market. So obviously, the price targets went lower. And then, we all know that the Fed came in with stimulus one, two, three, QE unlimited, and here we are today.
Yeah, it's
But
been
once
tough to.
again, it's just looking ahead at the market. So I'm trying to look ahead now. What's going to happen before before Q2 earnings because I believe it's going to go down, and then we should have another leg up after that.
Yeah, I mean, things have varied quite a lot, and so when you're trying to verify where we're going, it really, uh, you have to stay nimble in the market right now.
Absolutely, this is a time for being very nimble in the market, and we've been nimble. Our portfolio shows that. We're up 30%. Our portfolio is very diverse. We have various assets. We have GSMs, I call them, gold, silver mining companies, so GSMs. Um, well, we also hold some physical gold and silver. We have probably around 40, 50 different stocks, different split up amongst different sectors, and we also have cryptocurrency.
You
So
said
we have
30% in what time frame?
30%. We're up 30% in this quarter.
This quarter. Got it. Okay.
Yeah,
Great.
and we're up 32% for the year.
So you were up in Q1.
We were up by 2%. We squeezed out a 2% gain in Q1. Thank you to hedging. Thanks to hedging and put options, we did squeeze out a very small gain in Q1.
So what did that look like? You're hedging and put options. Are you taking your writing puts against the broader market, or how did that
Yeah,
play out for
yeah.
you?
Major market averages, DIA, QQQ, taking out puts against some positions that we have in our portfolio. We were also implementing a sell call buy put strategy at this time with some names, and we also went long VIX futures up. And in some cases, we also shorted some major market index futures as well.
Okay, very interesting.
So we did quite a bit of hedging,
Evidently, yeah, that's
which is why we were a bit positive in Q1.
yeah, no, that's impressive. So
And Q2's been good, even though we've been cautious. We've held like a cash position of around 20% throughout the quarter. We're still doing quite well. Our stock part of the portfolio was up about 40% this quarter. So I mean that's pretty good, I would say. So we're doing all right.
absolutely. So let's just go into mining. What do you like
Let's
about
go.
mining? What
I
what
love mining.
what about it do you like? There's the obvious, I guess, inflationary. Fed and central banks around the world are stimulating, etc. But
Yeah,
why do
yeah,
you like
it's
the setup?
right. So I mean, you say it's obvious, but I'm I think that people are underestimating the um, what is going to happen in the future. So I mean, people say that it's obvious, but a year ago, almost no one was in mining. We were in mining because we were looking ahead. So people say that it's obvious that there's going to be inflation, the Fed is spending, but the fact is, if you look at the numbers, the monetary base has appreciated by almost an exact percentage term as gold's price since the decoupling from the gold standard in early 1970s. So I mean, we can see a very clear correlation here. So now we're looking at a monetary base that is about $5 trillion. Now we know that the Fed is planning to greatly increase its balance sheet, blow it up to around 10 trillion. I think it's going to be 12 trillion. So we can objectively say that the monetary base may be around 10 trillion, maybe in a year from now. So if we look at it from this perspective, then gold has quite a bit of catching up to do. If the monetary base increases by say 100%, why shouldn't the price of gold increase 100%? Most people right now are not expecting $3,000, $3,500 gold prices next year by this time next year. I am. I think that we're going to see at least 25 to 3,000 by this time next year. I think we could see 3,500 by this time next year. Now, I like mining companies obviously because they make money from deriving gold from the ground and from other operations. But basically, that's the not to oversimplify things, but that's basically how they make their money. They're all in stable, sustainable costs, and it's something like $1,000 for most companies. It can be a little bit lower for some. maybe a little bit higher for some, but it's around $1,000. Now with gold, now right now gold is at 1,700. Obviously, they're making a lot of money. Now when gold is going to be at 2,500, and I'm quite confident it's going to be there next year, they're going to be making a great deal of money. So we're looking at, you know, I would say conservatively speaking, maybe 100% moves from here in gold miners, maybe 200% moves in gold miners, maybe 300% gold moves in gold miners within 1 year or 2 years. I don't think you're going to find that in tech or in oil and utilities or just about anywhere else in the market. So I mean, that is our thesis. We're sticking to it, and that is why we love gold miners.
Let me ask a couple before we get into any names. Let me ask a couple sort of drilling questions there. To pardon the pun, but the one point that another author made on one of these videos, I think it was Lawrence Fuller, but I could be wrong, was that a lot of the buying for gold has been siphoned away by crypto. And I know you're into cryptocurrencies as well,
Yeah,
but do you
big
buy that
time.
that's a competitor for this?
A little bit, but not
Okay.
much.
So you don't think that that's going to be a major factor here.
No, I don't, not at all. I think the crypto market is extremely small right now. It's the market cap of the whole cryptocurrency market is something like $260 billion. So I mean, that's minuscule. That's minuscule. That's that's like nothing.
Do you? So the next question is where? How does this go? What are you looking at as the potential risks, or as the potential something goes? You're making a pretty bold call for the sector. Where
Right.
a year from now it doesn't play out? What's happened?
So I mean, the only real risk that I see is the risk of deflation. That is honestly the only risk for gold prices and for prices in general. If we see deflation, and the only reason we would see deflation is if we have an incredibly deep recession where just consumption dries up and all asset prices start to decline. But I mean, the Fed is doing everything to prevent that. So the probability of that occurring is maybe two 2%, 1%, something like that. So I mean, there's about a 98% chance that that's not going to happen. So I mean,
Well,
I'll take those odds.
there's a fair. I mean, I'm not. I haven't studied it up, but there is a fair bit of discussion out there about are we in an inflationary going into an inflationary period or deflationary? Obviously, we've sucked out a lot of consumption and a lot of production out of the market in the or in the economy in the last 2 to 3 months. So there's going to be some scars from that. So it will be interesting to see whether the monetary base is increasing, but does that play out in price inflation? Does that play out in asset price inflation?
Right, right. Yeah, I think it will. I mean, there's just so much money being poured into the system, and I mean, we see it in stocks right now, and later on, it's going to filter into the real economy. We're gonna see prices rise across the board, and I think we're gonna see prices rise across the board like we've never seen before. And people are really gonna. I think they're gonna panic, to be honest with you, because wages are not gonna rise in proportion um, with the rising prices of goods like milk and just basic necessities. I'm not talking about computers or washing machines. I'm talking more about food prices, even energy prices perhaps. So I mean, it's gonna be bad. It's basically gonna lower people's standard of living, but there's gonna be inflation. It's coming.
As if we need more tension in the world with that. The so my last question: what mining names do you like, or how are you playing this?
So we have quite a few of mining positions in our portfolio right now. We have personally I like ETFs a lot. So I mean, obviously we all know the benefits of ETFs. You don't need to pick and choose companies. You get a basket of companies. Um, when it comes to gold and silver miners, there's the best ones typically make up, maybe 40, 50% of the weight, like the top 10 companies. 40, 50, 60, maybe 70% of the weight. So if we're talking about ETFs, I like GDX. I like GDXJ, which is a gold miners juniors ETF. It's for smaller cap gold miners.
Mm-hmm.
GDX is for large cap or bigger cap gold miners. We also like SLVP. This is a gold and silver mining ETF, a very interesting combination. And then there's the SIL, which is a silver mining ETF. So we own all four of these. We like all four of these names a lot. And what I feel they do, the ETFs, is that they add a lot of, or they add some, they definitely add something very important to your portfolio, to our GSM basket or GSM segment of the portfolio. So they're basically complementary to the gold mining names that we own. Our core positions are in Kirkland Lake Gold. We like a lot. This is an excellent company. Makes a lot of money. Trades at a P of like 12. Supposed to grow revenues double digits. I mean, it's just extremely cheap. I can't believe it's cheap right now. Newmont Mining is a great name. Obviously, I believe it's the biggest gold miner in the world. Um, Also not expensive. It's trading at, after the recent correction, it's trading at around 20 times forward earnings. Growth rate is also double digit. We like probably our favorite name. One of our favorite names is a smaller cap gold miner. It has a market cap of like 5 or 6 billion. It's called Kinross Gold. The symbol KGC. This is an excellent company. It's trading at around, I believe it's trading at under 10 times 2021 projected consensus earnings, which is just incredibly cheap. And it has a growth rate, a double-digit growth rate, revenue growth rate. So it's supposed to grow revenues by, I think, 15% next year. I believe these numbers are also under underappreciated right now. I believe that analysts are projecting their future EPS and revenue figures based on maybe 17, $1,800 gold prices. Maybe some analysts are projecting 15 or $1,600 gold prices. But I'm pretty confident that if they were basing their analyses on 2,000 or $2,500 gold prices, they would have much higher EPS and much higher revenue growth estimates for 2021. So a few other names that we like is First Majestic. First Majestic is a silver company, symbol AG. Our favorite silver miner is Pan American Silver, PAAS. We have a big position in that one, and we also like Fortuna or Fortuna Silver. FSM is a symbol for that one. And let's see, aside from that, we also like Alamos Gold. AGI is a symbol. And that is about all we own in the gold mining sector right now. We have this company, we recently bought this Russian company, Nornickel, symbol NILSY. This is a very big company. It's a $50 billion company. I believe I'm sure it's one of the biggest miners in the world, but they don't only derive gold, they're into copper and nickel, and they're basically into all metals. But this is a great company, very cheap, trades at like a 7 trailing PE, and it pays a very nice over a 5% dividend. So symbol NILSY, great company to look at going forward.
Okay, it's quite the list. So it sounds to me like it's really, you have a basket of names, you have the ETFs, and so you really think about it at the asset allocation level, and you're allocating a lot to this sector because you
absolutely. This sector right now makes up about 22% of our portfolio.
Okay, it's quite a sizable chunk. So
absolutely, because we believe in it, and what we believe in, we invest in, and that is why we usually beat the market.
All right. Well,
it's as simple as that.
I've been talking to Victor Dergunov, who is the author of Albright Investment Group. You've just heard his case for the gold sector. Victor, I presume positions in all of those mining names you mentioned. Any other disclosures that you need to make? You mentioned Tesla earlier. Any other names you need
We're out of Tesla. We
Oh,
actually sold at the, like right around the top, 850. And I know it's trading a bit higher right now, but we just, I'm just looking at it right now, and I don't want to chase it up here. I love Tesla. I've owned it for years. I've owned it since 2013. Um, but up here, I know the stock is going higher. I mean, if you get me talking about Tesla, we're going to talk for another half hour. But I'll make it brief. I'll make it very brief. I'm a big believer in Tesla. All right, I love the company. They're doing amazing things, and I do have a very high price target on Tesla in about 3 to 5 years from now. It's in the thousands. So we're talking about $3,000-4,000 price target within a 3 to 5 year time frame. However, once again, Q2 is going to be horrible. We're going to have a sell off into Q2 earnings, in my view, and we're going to pick up some Tesla shares on their way down near the lows. Not at $880. We're going to buy some at $550 or maybe lower.
okay. So we've got a timestamp on that. So we'll see how Tesla, of course. I've managed to avoid talking about Tesla on these videos and on the podcasts I've run, and I'm generally proud of that. To
Hey,
say,
look, Daniel, let me just bring this up. My first ever article about Tesla was an essay was I believe in 2017. It was titled "Will Tesla Become a $1 trillion company?" Now, in this article, first when I wrote it, it was just the comment section was ridiculous. But anyways, one of the things I mentioned in the article was by around 2020 to 2021, we're gonna see the stock at $1,000. And obviously I got a lot of laughs for that. But I mean, here we are, and I mean, people can go and look at the article. It's my first Tesla article that I've ever wrote for the site. We can go back to that article, and I mean, here we are in 2020. Tesla's is or was at $1,000.
I see an article from October. Well, you know what? I probably my screen is blocking your first article. I do see an article titled "Tesla's $1 trillion Future." Looks like it was probably a video interview you did with
Yeah,
Chad.
no, that was later. My first article on Tesla was before then. It's called um, "Will I believe it's called Will Tesla Become a $1 trillion company?" or something like that.
All right, all right.
And I believe that it will in time.
Okay. All right. I should disclose I actually have small positions in GLD and in Newmont and a position in Google, which you brought up earlier in the text.
Cool. I like Google.
So, all right, Victor, best of luck. Very congrats on an impressive start to the year, and I hope it continues to play out well for you.
Thank you, Daniel. I appreciate it.
All right.
It was great speaking with
Yeah, absolutely. Yeah. Well, hope we get to do it
you.
again.